Lower mortgage rates and rising inventory are giving home buyers a window of opportunity at an unusual time of year. According to a report from housing data giant Zillow, nationwide active inventory was up 22% year over year in August, although it remained 31% lower than the pre-pandemic level of August 19. Meanwhile, new listings grew slightly monthly and yearly, but were 21% lower than the same month in 2019. Zillow reported that unlike at the height of the rate hikes, when renting was cheaper than buying, the opposite's true in 22 of the 50 largest metro areas. According to a report on Realtor.com, significant home buying activity this fall could be seen in expensive California cities where the rate cut could have the biggest impact on monthly mortgage payments. I just posted another video specifically discussing the 17% increase in buying power in the San Jose area. Though the half-point Fed rate cut is meaningful, as the market anticipated it beforehand and adjusted accordingly, many people feel it will be 2025, particularly in spring, when buying and selling kick into high gear. Though many investors are hoping for further rate cuts, too many too soon could cause a frenzy in the housing market that would be detrimental to both buyers and investors, resulting in higher prices that could eradicate any increases in inventory. It's a double-edged sword, because lower interest rates will allow rate-locked homeowners to sell and thus create more inventory. However, if the rates drop too precipitously, prices will rise. In the commercial realm, as interest rates decrease, cash flow coverage increases, bringing down loan loss reserves for banks. Those lower reserves can then be put back into the market and facilitate more deal flow, as mentioned by Al Brooks, head of commercial real estate for JPMorgan Chase. That makes it easier for prospective commercial real estate borrowers to get loans from banks. Even if the rates aren't exactly where investors want them, looking for opportunities and starting conversations with lenders early in anticipation of further rate cuts is probably a good idea, considering how long commercial real estate deals can take to close. If there was ever a time to buy and hold real estate, it's now. With the Fed signaling that 18 months of rate cuts are ahead and prices likely to rise with increased affordability, simply buying now and selling once this happens is expected to be profitable, even with a minimum amount of work. Of course, it means buying right, regardless of asset class, and not paying too much. Regardless of your investment preference, commercial, residential, flipping, or buying and holding, buying this fall should prove a prescient move before the next round of rate cuts. Reach out to me directly, and I'll share more with you and what I'm doing with my own investments and advising my investor clients. I'm Keith Walker. Thank you.